Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. Last week, as expected, the Fed opted to keep rates unchanged for the eighth consecutive meeting in a range of 5.25% to 5.5%. In the statement, the Fed offered a relatively solid assessment of the U.S. economy and the labor market. The language noted that job gains have, quote, moderated, and while there has been a rise in the unemployment rate, the level of joblessness remains, quote, low. On the inflation front, the Fed also appeared to offer an improved assessment, at least somewhat. In recent months, the statement reads, there has been some further progress towards the committee's 2% objective, but inflation still remains somewhat elevated. Even with more tepid improvements, the committee furthermore now judges that the risk profile between its employment and inflation goals continue to move into better balance, although the statement stops short of indicating such a balance has yet been met. As such, rather than focusing on just inflation risks, the committee says it will be attentive to the risks on both sides of its dual mandate. Most importantly, the committee reiterated a reluctance to adjust policy without further evidence of a sustained disinflationary trend. Now, this was language many in the market anticipated the Fed to remove, but rather it remained. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. In other words, the July FOMC statement offered no guarantee of a September rate cut, falling short of the market's expectations for a commitment to policy easing. While a September rate cut is still a possibility and very much on the table, in fact, a September rate cut is priced in at near certainty, according to the CME FedWatch tool. But the statement itself suggests the Fed remains data dependent, and furthermore, that policymakers are not yet convinced by recent reports that price pressures will continue to moderate, or that labor market conditions have cooled enough to warrant an adjustment in the current stance of policy. Progress has been made, but the committee is looking for additional indications of sustainable progress back towards that 2% inflation objective. That's not to say the Fed needs to or will wait until 2% is met, but the trajectory of inflation still remains bumpy and uneven at best. With just 2 months of downward momentum in the headline PCE, coupled with further sideways movement in the core, policymakers, desperate to provide relief, will continue to put a heightened level of importance on the incoming data between now and the September 18th FOMC meeting. That being said, it appears the onus is on the data to convince policymakers not to move come September, meaning any further minimal progress in price pressures is likely enough to offer the needed justification to cut rates in just about 6.5 weeks' time. After all, as Powell indicated during the press conference, the economy is in a relatively good spot, and the Fed would like to perpetuate and support current conditions. But while we're approaching the point for an adjustment, he said, we're not quite there yet. In the aftermath of the Fed's sideline decision, the Bank of England, meanwhile, opted to take action and cut rates 25 basis points to 5%, marking the first rate cut since early 2020. Amid a 0.7% growth rate in the first quarter of the year following 2 consecutive quarterly declines, and inflation subsiding to 2% for the second consecutive month in June, the lowest level since July of 21, the committee voted in favor of a rate cut 5-4. Coming back to the U.S. also last week, as investors continue to digest the latest Fed commentary, all eyes shifted to the July employment report as the first of several key data points between now and the September meeting that will continue to tilt the rate policy tables in one direction or the other. Non-farm payrolls rose by 114,000 in July, falling well short of the 175,000 gain expected, and now marking the weakest increase in 3 months. The 3-month average, meanwhile, did rise slightly from 168 to 170,000. In the details, goods-producing payrolls increased by 25,000, while services payrolls rose by 72,000 in July, following 125,000 gain the month prior. Education and health payrolls led the gain in July, rising 57,000, down, however, from the 79,000 rise in June. Construction payrolls also rose, gaining 25,000. Leisure and hospitality gained 23, and trade and transportation rose 22,000. Government, retail, manufacturing payrolls also increased for the month. While on the weaker side, business services payrolls dropped 1,000, financial payrolls declined 4,000, And information payrolls dropped 20,000, the largest monthly decline since October. Meanwhile, household employment rose by 67,000 in July, following a 116,000 gain in June. However, with a larger 420,000 increase in the labor force, the unemployment rate unexpectedly ticked up from 4.1 to 4.3, now marking the highest level since October of 21. With the labor force participation rate then ticking up to 62.7% in July, a 3-month high. And finally, average hourly earnings rose 0.2 in July, a tenth of a percentage point less than expected, and following a 0.3% increase in June. Year over year, wages rose 3.6%, down from a 3.8% gain the month prior, and now marking the smallest annual increase since May of 21. Along with the latest payroll data, an updated release from the JOLTS survey, or the Job Openings and Labor Turnover Survey, showed the total number of job openings fell to 8.2 million in June, a 2-month low, although still perpetuating the notion of tight-ish labor market conditions as labor demand continues to outpace labor supply. That being said, conditions are somewhat less tight than they were at the start of the year. So while arguably rebalancing at a gradual pace as a result of the fastest backup in rates in 4 decades, the expected slowdown in demand and the overall impact on the U.S. labor market remains relatively muted, again suggesting more of a normalization of labor market conditions as Powell characterized it, as opposed to outright weakness. Of course, even with broader indications of stability, there are some signals of a more sizable slowdown elsewhere in the economy, or at least indications of a further loss of momentum, particularly as younger and lower income consumers more heavily adjust spending, reducing the amount of nominal dollars spent, as well as reallocating expenditures towards services and away from goods, compounding pressure then on manufacturing. In the latest read, U.S. factory activity moved further into contractionary territory, declining from 48.5 to a reading of 46.8 in July, now marking the 4th consecutive month in contractionary territory and dropping to an 8-month low. In the details of the report, prices paid rose to a 2-month high, and supplier deliveries increased to the highest reading since August of 22. On the other hand, new orders fell to a 2-month low, production slipped to a reading of 45.9, and inventories fell further into contractionary territory. Also, employment fell nearly 6 points to the lowest reading in 4 years, perpetuating concerns of a potential further cool down in the labor market coming down the pipeline. This week, the economic calendar is quite light, but it does begin today with a look at the final S&P Global U.S. Services and Composite PMIs for July and the ISM Services Index for July. Last month's services activity unexpectedly dropped back into contractionary territory, or a reading below 50, dropping 5 points to a reading of 48.8 in June, the lowest reading since May of 2020. This month's services activity is expected to move back into expansionary territory at a reading of 51.3 in July. Tomorrow, we take a look at the June trade balance, followed by weekly mortgage applications on Wednesday, along with consumer credit. Later in the week on Thursday, weekly jobless claims and wholesale inventories for June. And finally, backing up to later today on the Fed front, the latest SLOOS report, or the Senior Loan Officer Opinion Survey on bank lending practices, will be released. We'll also hear from a number of Fed officials, including San Francisco's Fed President Mary Daly and Chicago Fed President Austin Goolsbee. And later in the week, Richmond Fed President Thomas Barkin speaking on Thursday. In the aftermath of a somewhat more hawkish than expected Fed statement in July, investors will be hanging on every word from Fed officials to glean any updated assessment of the Fed's latest decision in the aftermath of the somewhat disappointing July employment report. And with that, I'd like to thank you for starting your week with Stifel.